Los Angeles, and this is Bloomberg Technology. Coming up in the next hour, the latest on the Broadcom acquisition of CA Technologies. A memo sent to lawmakers calling for the deal to be reviewed has been tagged a fake. Plus, is the auto industry on the verge of a tech disruption? Macquarie's prediction gives Tesla a boost. We will speak to the analyst behind the forecast. And Snap's betting a new slate of original shows can give it the edge over Instagram. But will it be enough to hang on to its key audience? First to our top story, Broadcom has said a memo purported to be signed by the U.S. Department of Defense circulating among members of U.S. Congress calling for a possible review of the company's acquisition of CA Technologies is a fraud. The products of CA Technologies are found in defense, finance, and energy industries. The Pentagon is also saying the memo circulating is likely a fraudulent document. So where did this memo come from? For details, we're joined by Bloomberg's Ed Hammond in New York. So, Ed, what are we learning about this?
Well, what we've learned so far, Emily, is that, yes, as you say, this memo is probably a fraud. Broadcom have obviously come out very quickly and said they think there's some problems with it. I actually got sent an early sort of draft of what it looks like, and it does look like there's some inconsistencies here. The Broadcom is referred to as Broadcom Limited. Obviously, that's not the name of the company. It's now Broadcom Inc. Also, the date on it is August 3rd. So if it is a real memo, which we don't think it is, that would suggest it's kind of historic at this point. And then there were some other problems with it. There are some misspellings in terms of senators' names in there, which obviously is slightly strange if this is anything close to real. And as you say, the Pentagon have now come out and also denied the veracity of it.
Now, Senator Rand Paul has come out saying this deal is a security risk. It should be subject to national security review. Is that as a result of this memo? And does that comment still stand?
That's really interesting, and that's going to be a big question going forward. He cites some stuff from this memo in those comments. I think he talks about 29 nuclear reactors in which CA Technologies is embedded. That comes directly from this memo, as far as I can tell, and is potentially therefore wrong. But look, Broadcom is a company that we know is something CFIUS has looked very closely at in the past. They blocked them from doing the Qualcomm acquisition because they said even though then they were technically sort of a Singapore domiciled company, but largely a US-based one, they said we don't trust them. We don't think they're going to be good actors here. Do they do the same on CA? It will remain to be seen whether or not they even have the jurisdiction to do it, because CFIUS obviously can only really look at deals where the acquirer is coming from outside the US. That said, and I think this is important, we need to note, CFIUS very recently just got new powers. They've been given a broader mandate in terms of what they can actually regulate regards to US deals, and one of those things is, look, any company that has interstate commerce within the US, obviously Broadcom and CA both fall squarely into that, so they may take a look at this, and they may indeed decide that this isn't a deal they don't want to go through. But what we do know for now, at least according to the Pentagon, is they have not asked for any such review.
So, you wrote a piece a couple of weeks ago about how a rise in nationalism and certainly some of the policies of the Trump administration is sapping deal flow. One, do we expect this deal to move forward? And two, do we expect other deals not to happen as a result of these policies?
The second part of that I can answer very easily. I think, yes, we expect other deals not to happen as a result of these policies. I think particularly any deal inbound into the US, especially where it involves anything related to critical infrastructure, which is a bit of a moving feast because obviously that can change depending on what the administration defines as critical infrastructure. But anything that's tech, particularly around the semiconductor space, I think that's just a no-go for foreign acquirers right now. Does this deal go through? Look, I think obviously Broadcom are fairly confident it does. The spread was not huge. I think, Broadcom is now a US company. As I say, they still have Hock Tan, who, there's been some noise around him and whether or not sort of the CFIUS are comfortable with him as an owner. But that said, they've done a lot of deals in the US that have gone through previously. The only one that they've been blocked on was Qualcomm, which is a different kind of deal, but also the order of magnitude there was significantly different. That would be taking out essentially, the largest single player in the US in this area of semiconductors. So I think there's a very good shot that this deal does go through. That said, more broadly, we are looking at a much tougher regulatory environment for any foreign acquirer coming to the US, and indeed any foreign acquirer going into Europe, or for that matter, China.
Right. The Qualcomm takeover would have been the biggest tech takeover in history. The White House shot that down. Ed Hammond, I know you'll continue to follow this story, try to find out where that memo came from. Bloomberg's Ed Hammond in New York. Thank you so much. Well, moving on to tech investing, SoftBank continues to plow billions of dollars into, well, it appears just about everything. This time, the target is once again the co-working startup WeWork. Now, SoftBank's Vision Fund is said to want a controlling stake in WeWork, which means that the new financing could total anywhere between $15 to $20 billion. This, according to the Wall Street Journal. SoftBank already has a $4.4 billion stake in WeWork, and Masayoshi Son has indicated he is not satisfied with just one Vision Fund, even though it's already got major investments in companies like Uber, ARM, NVIDIA, and more. He plans to launch new $100 billion funds every few years. Here with us to discuss, we've got David Kirkpatrick, Techonomy Editor-in-Chief, and Bloomberg Sarah McBride, who covers the venture capital scene. And Sarah, you recently interviewed Masayoshi Son. He told you about his ambitious plans for multiple funds. What do you make of this new WeWork news?
Well, it fits in with his plans to deploy $100 billion every 2 to 3 years. That's a lot of cash, so the size of the WeWork investment being discussed would fit right in with that. Works for WeWork, which is doing this big expansion into Asia and other areas. The one missing piece is, will it pay off?
Well, and that's the question, David. WeWork was reportedly seeking a $35 billion valuation. This would be much less. It's still losing hundreds of millions of dollars, and it has yet to prove if the revenue that it's bringing in is sustainable and if it will continue to grow at its current pace. Is this a good bet for SoftBank at this size, David?
Well, it might not be a good bet for some people, but both WeWork and SoftBank Vision Fund are shoot-the-moon operations. So WeWork is a shoot-the-moon company, and the SoftBank Venture Fund Investment Fund is a shoot-the-moon investor. And they're basically both willing to make humongous bets, and they're sort of, enabling one another. Obviously, if WeWork does raise another $10 billion plus from SoftBank, that allows them to do a whole lot more. And then, it begins to be possibly a self-fulfilling prophecy. They aren't making any money. They're far from making money. But if they can expand fast enough and maybe then go public, maybe when the markets remain frothy, as they basically continue to be in the public sphere, maybe SoftBank can get their money back and it'll all be great, even if WeWork doesn't long-term become the only place we all work. And by the way, I work in a WeWork, so WeWorks are good.
I hear they have good drinks on tap, David.
They do.
Look, Masayoshi Son has been very clear. He thinks this is a big opportunity and that they're not going to lose money on the Vision Fund in general. Take a listen to what he had to say last year.
The Vision Fund deal is the preparation for a God-given opportunity similar to the gold rush era that's approaching. We have acceptable money from partners to avoid building debts, and we are sure the fund will be a success. We should be thinking big for this lifetime business opportunity.
That said, Sarah, what kind of returns are investors in the Vision Fund expecting? Are they thinking 2x, 5x? A typical venture capital fund, if it does a good job, is closer to 10x.
Right. So last year, Masa said that the Vision Fund had already returned in excess of 20%, which is, most funds are definitely operating at a loss for their first few years of existence. This is barely a year in. He said his personal rate of return since 2000 has been over 40% annually. So, perhaps ask him what it's been since 99 or 98 before the big .com run-up and crash. But still, that's very impressive over the past 18 years. So investors are hoping some of that personal magic he's had will rub off on the Vision Fund, and he's prepared to make these big, bold bets, even if the bulk of them don't work out. He thinks he's going to have one or two that knock it out of the park, just as he did with Yahoo and Alibaba. It almost became irrelevant that he had dozens more investments that went nowhere. And so because of that track record, investors are prepared to buy in and listen to him. And with WeWork, I think he and the WeWork CEO, Adam Newman, have kind of a personal connection where they're both prepared to just make these big, brash plans and just think that the world will follow along, and they're kind of betting on social movements as well as just real estate, that more and more people like David are going to end up working out of offices that are more convenient to them than perhaps the offices of the companies that actually they work for.
The Vision Fund has already invested in, we were looking at some of the companies there, Uber, a construction company called Katera, the Indian e-commerce company Flipkart. David, you may love your spot in your WeWork office, but I wonder if there's a concern that SoftBank, by investing so much money in some of these companies, is keeping companies afloat that maybe shouldn't be kept afloat.
I wouldn't go that far yet. I think there's a real risk of that. I mean, we are in an extraordinary up economy, basically really dramatic up markets, beyond what most of us expected. But these companies are growing, and some of the SoftBank investments, like NVIDIA, is a really, really strong company. The other chip company, the name of which is escaping me, which is such an amazing chip company, it was just on your list. But, those
ARM.
two chip companies, ARM, thank you. Sorry for my brain. But ARM and NVIDIA, these are like really powerful companies that are already hugely profitable. So those are different kinds of investments. And I think that the amount of money that SoftBank's trying to deploy with the help of some Saudis and others, it's a little dangerous for the economy in general because they have to find these huge bets. And huge bets can go hugely wrong. So far, they haven't. So, let's hope for them that they don't.
Let's talk about the Saudi investment. Saudi Sovereign Wealth Fund investing another $45 billion in SoftBank's Vision Fund. Sarah, talk to us about the dynamics there. What does that mean?
Well, it means that the Saudis so far have been really pleased with how the Vision Fund is performing. They have a big investment conference coming up in the next few weeks in Riyadh, and Masayoshi-san is expected to be there, and we'll probably talk about the performance of the fund. And Mohammed bin Salman and Masayoshi-san seem to have forged a relationship that's very simpatico with each other, and they seem very happy with it so far. The interesting thing at SoftBank might be more internally, are all the investment managers on board with this investment? This would be one of the bigger ones at the Vision Fund, and that's another question for SoftBank.
David, what are the political implications of the Saudis having such a huge stake in this fund that is investing in American and globally ambitious companies?
Well, I think the political implications of anything connected to Saudi Arabia and the Crown Prince bin Salman are different this week than they were before. If it really does turn out that the Saudis murdered and possibly dismembered a dissident in their consulate in Istanbul, which is looking quite likely, I think the reputation of that country and of that leader will plummet. Many of us who believe in democracy have been somewhat distressed, very distressed by the things we've seen in the more or less autocratic approach that the Crown Prince has taken to changing that country already. Some of them sound good on the face of it, letting women drive, etc. But if the way they're doing it is by becoming, a state that will essentially assassinate its citizens when they criticize them, that's going to color and taint anyone associated with it long term, I believe. So I would say Masayoshi-san should be careful how close he stays with the Crown Prince.
All right. Techonomy's David Kirkpatrick, Bloomberg, Sarah McBride. I should add that the Saudi officials have denied allegations that they are connected to that, but of course it's something we continue to follow. Coming up, is technology pushing the automotive industry into a new era, one that could put Tesla on top? We'll talk to one analyst who's betting big on that idea next. And if you like Bloomberg News, check us out on the radio. You can listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. A big name being dropped as a potential replacement for Elon Musk as Tesla chair. none other than James Murdoch. This according to the Financial Times. This comes as Tesla snapped a 5-day losing streak that shaved $10 billion from its valuation Tuesday after Macquarie started coverage with a buy equivalent rating indicating the company is on track to reach profitability. Meantime, short seller Fahmi Kadir is betting on a dramatic drop in Tesla shares, saying the electric car maker seems to be between a rock and a hard place because it needs to raise money through debt or equity. So, has Tesla actually reached a turning point? To discuss, we are joined by Macquarie senior analyst Maynard who sees the auto industry entering into a period of unprecedented disruption. Also with us, Bloomberg Business Week's Max Chafkin, who writes extensively on Tesla. Max, I'll start with you. What's your take on this James Murdoch situation?
I mean, I think it kind of makes sense. Tesla, there's this kind of weird paradox with Tesla where they want to rein in Elon Musk, but they don't want to rein him in too much because his presence and kind of his essential Elon-ness is part of the appeal. So I think what's happening with Murdoch is like he's pretty close to Elon Musk. I think they're friends. He's been on the board for a while, but he's also independent. He has his own profile. He creates a little bit of at least a veneer of independence that the board had compared with what the board had before.
So, Maynard, your note is likely the reason that Tesla shares have run up over the last couple of days. And curious if this James Murdoch potential makes you more or less optimistic.
I think the most important thing really is that Elon Musk is really just focused on building Model 3s and getting deliveries out there. Anything that really just gets that focus down to that, I think is actually a very positive thing. So if James Murdoch's the one who can actually rein him in and prevent some of that the tweets going out, and the focus really comes back to the deliveries, which is really the fundamentals of the business, I think that'll end up being a very positive for the company.
Well, the question, Max, is can James Murdoch rein him in? I mean, James Murdoch has been on the board, and Elon Musk's behavior has been as it has been.
No, I mean, I think the reining in is going to have to come from Elon himself. And just because of the sort of his larger-than-life profile, the extent to which kind of his sort of personality has defined Tesla, I think if you believe in this company, what you are hoping for is that Elon himself will see the light, not that the SEC or a board member or someone else is going to do that for him. And I think if we've seen anything, if we've learned anything over the last few months, is that Elon, even when Tesla has been dinged for various reasons, he's still been willing to kind of be his own person. And so yeah, I mean, I think that the chairmanship is important. It's an important milestone for the company, but I don't think that alone is going to bring much change.
So, Maynard, talk to us about how you came to your conclusion that this is a buy, and in the face of some staunch opposition from the bears. I just mentioned an earlier analyst who believes actually Tesla shares are going to go in the opposite direction.
So my big call here really is we're taking an angle of looking at the sector really from a disruptive perspective and from a technology angle, which I've covered for the past 20 years. And a lot of people will talk about electric and autonomous as really kind of being the disruptors. We look at it as really kind of the enablers, and I think this is going to enable a platform ecosystem. So think about developers building applications directly on top of the car, and it'll turn that car into an application. So you download something, you press a button, and then you turn that vehicle into a ride-sharing vehicle, or you download a different app and turn it into a delivery vehicle. And ultimately, the reason why we're so bullish on Tesla is because if you actually look at the commercial technology that's already built into the car, a lot of those platform ecosystem technology is already there. And that's what makes us really positive on the long-term story for Tesla.
Now, we know that production numbers over the last several weeks have looked good, but what we don't know is if Tesla can sustain that level of production over the next few weeks. You are optimistic here. You believe production numbers will look good. You believe Tesla will reach profitability, but what has to happen in order for that to happen in your view?
So you're absolutely right. Our outperformance is definitely predicated on the near term and them being able to generate cash. We've done a lot of work around zero-emission vehicle credits, and we think in the back half of this year they can generate somewhere in the neighborhood of around $500 million. And remember, there's no cost associated with this, so this is going to be pure cash flow, which I think helps in addition to the free cash flow generation that I think they'll get going into the third and into the fourth quarter. And then I also think that they have some unused debt commitments that they can also tap, which will be more than enough to cover the debt commitments that are coming up over the next 3 quarters.
Now, Max, we're getting some new information that Tesla is closing in on a $145 million plot for its China factory. Obviously, China, a huge part of Tesla's potential. What does this mean?
Yeah, I mean, this is a big deal. The Chinese market for electric cars is, massive. Tesla really hasn't made much progress there at all. And if Tesla is able to get into the market and really sell some cars, that will go a long way to sort of improving its bottom line and just generating huge amounts of revenue. Of course, with China, especially in the Donald Trump era, there are always regulatory hurdles. So, being able to find a location for this factory, that's an important, kind of first step in terms of building a factory.
All right, Bloomberg Business Week's Max Chafkin, Macquarie Senior Analyst Maynard will have a lot to look for with earnings coming up in the next few weeks. Thank you both. A reminder, Bloomberg Tech live streaming on Twitter. You can check us out at Technology and be sure to follow our Global Breaking News Network TikTok on Twitter. This is Bloomberg. AI could soon enable your smartphone to automatically respond to messages on your behalf. Consumer electronics startup Essential Products is said to be working on a new kind of phone that would mimic the user using AI to respond to emails and texts or book appointments on its own. The design of the new mobile phone isn't like a standard smartphone with a smaller screen requiring users to interact mainly through voice commands. An internal memo underscores Amazon's growing momentum in cloud computing. Amazon Web Services has signed deals with SAP and Symantec worth a combined $1 billion. The memo says Microsoft, the number 2 cloud service provider, has also competed for the Symantec deal. And Uber is pitching a $1.5 billion junk bond sale. The ride-hailing service marketing the bonds at a time when fixed-income investors have proven receptive to debt deals backed by cash-burning tech companies. Uber has said it plans to go public in the second half of next year. And still ahead, social media giant Snap announces a large slate of original content, but will it be enough to take on Instagram? And Google's Waze is making a big bet on carpooling. We'll talk to the CEO about the company's new feature next. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in Los Angeles. Snap announced it will release a dozen original series on its mobile app, betting that a new entertainment lineup can maintain its grip on teenage users and give it an edge over Facebook's Instagram. The programming slate announced Wednesday marks Snap's biggest push into funding and producing its own content. Here to discuss, we have Bloomberg Tech's Sarah Fryer, who covers Snap and Facebook, and Raymond James Senior Analyst Aaron Kessler. So, Sarah, first of all, walk us through what Snap is unveiling here. They already have a bunch of original shows. Now they're adding new ones?
Yeah, so they've had some original shows for a while, but this is a completely new slate of programming. For a while, they've really encouraged outside content partners to make media for Snap and that then sort of build their brands in separate channels on the company's Discover page. Now they're doing it themselves in-house, and I think that they really want to demonstrate that they can do a kind of show that's very mobile first, that goes directly to that younger audience that Snap is known for reaching. The question is whether it will really attract users and growth down the line.
All the shows are shot vertically. One of them is called Endless Summer, a successor to MTV's Laguna Beach. Aaron, is this the sneak secret to Snap's future?
Yeah, I think that's going to be a big question. I mean, so far, Snap's had limited traction with some of its, we think, content offerings. If you look at the Discover side, most of the time spent on Snap is still within kind of the messaging part of the app, and we think that continues to be the case. The problem with that is messaging historically is not monetized as well. So to monetize, they are going to have to do things like the Discover side with more content, with more original programming. And that's a big question, and Snap's not the only one going after this. You have Facebook with the Watch tab, Instagram just announced kind of Instagram TV recently as well. Obviously, you have Netflix, Amazon Prime, so a lot of fragmentation on the content side. But yeah, I think for Snap to do well and to get more ad dollars, they're going to have to show more traction on these type of offerings.
Well, and Sarah, Snap executives have come out saying that these shows have been a raving success and that they have multi-millions of viewers. You know, how many people are actually watching these shows?
Well, what matters is not just how many people are watching individual shows, but whether that number grows. Snap last quarter announced a decline in daily users for the first time, and that has caused a shockwave through the markets, thinking that maybe this company is not going to get to a size big enough to compete with the Facebooks and Googles of the world for advertising dollars. So what they really have to do is prove that side, that media aspect of the app, can be a big moneymaker down the line. And there just isn't enough public information on how those shows are doing to really instill confidence. And certainly Wall Street is not too excited about these shows. The stock is down today, hovering below $7 for the first time.
Aaron, original content aside, how optimistic are you that Snap can continue to grow? I mean, they're losing high-profile executives. The redesign has been a bust. Evan Spiegel has said they have to get back to their roots, which is about communicating quickly. But, is it all enough to get back to growth?
Yeah, it's a good question. We haven't seen it yet. We're still cautious on Snap overall. While getting back to the roots of communication, fast messaging, fast sharing of photos is important for them, that doesn't really generate revenues like Newsfeed does with Facebook. So that's the problem they're trying to solve. You can't have it both ways. You can't just be a great messaging app at the same time make a lot of money on the advertising side with creating a great user experience. You need to have a little bit of both. We still like to see more product innovation. I think originals could help on that. But so far, I think there was a stat about only about 20-25% of users go to the Discover side of the app on a daily basis. That's a pretty low percentage that are not using kind of these content services from Snap.
Sarah, Evan Spiegel recently released a very long memo to employees where he talked about how the company had lost focus, how it has to get back to its roots. Some folks were making fun of his use of the word cheetah, which is the code name for this redesign. He didn't back away from cheetah entirely, but said certainly it wasn't working so far, but that everyone as a consolation prize would be getting a cheetah-themed sweatshirt. What do you make of this memo? What do investors think about this memo?
Well, I spent a lot of time with Evan Spiegel earlier this year, and the memo echoed a lot of the same things that he was trying to get across to me then, which is that the company sees itself differently than the other social media platforms, that they don't even see themselves really as a social media company. It's more of a messaging company with a media component, and that they want to allow people to experience the world differently. While Evan is trying to communicate more directly to his employees and address some issues with clarity around the company's direction, a 15-page memo is not always the best way to get that across. And certainly, while some people thought that this was a good eye into how Spiegel thinks, other people thought, it was a little rambling, a little concerning. And so I think that he's still in that place where he has to prove that he is the visionary leader for the next era of Snap. Otherwise, an analyst yesterday said they may have to raise money. There may be M&A down the line. I mean, he has to. This next quarter is going to be so crucial for the company's future.
Aaron, I'm sure many of these tech CEOs, don't love speaking to the press, but, now they do. We've seen Mark Zuckerberg mature. In this memo, Evan Spiegel talks about how he feels awkward even walking around the office and talking to employees. He doesn't love speaking to the press. But, at this point, this many years into being a public company, do you think he has to grow up? Do you think he's still the right person to be, leading this company?
Yeah, it's a good question. I mean, I think it's less important whether he's speaking to the press. It's more about company execution, and so far they haven't executed. I mean, if you look at the shareholder letter, it talked a lot about their competitive moats, but at the same time you're talking about competitive moats, you're also losing a lot of users to Instagram, it appears. And they talk about competitive moats being their speed of delivery, although you really haven't heard of users complain on Instagram or Facebook that they're not getting pictures or text sent fast enough. So it's a little confusing, that shareholder letter. I think investors were confused. I think that's why the stock did not really rally off of that letter.
All right, well, lots to watch. Aaron Kessler, Raymond James, Bloomberg Tech's Sarah Friar, thank you both. Now, Waze is announcing the rollout of Waze Carpool across the United States. The feature enables Waze users to request rides from other community members, with a goal to ultimately decrease the number of cars on the road. The company has spent the last year or so testing carpool in states like California and Texas. That's now being expanded to all 50 states. We spoke to Waze CEO Noam Barden and asked about how the company sees itself competing with the likes of Uber and Lyft.
So we don't see ourselves as taking on Uber or Lyft. We're taking on single occupancy vehicles. If you drive alone in your car to work, that's our competition, right? We need to give you a better experience so that you'll be willing to take someone with you or leave your car at home. And that's how we're focusing. Uber and Lyft are part of this. There are many mobility players that are going to be part of a full mobility solution. There's last mile components, there's scooters, there are cars, there are all different kinds of components. We're focusing on the long haul. Going from San Francisco to Mountain View, we will give you a price that's a fraction of any other alternative, and we'll give you an experience that's actually going to be a lot more fun.
How big do you think this business can be?
So that's a great question. We don't know, right? We don't know how big this can be. But if you think about it, there are trillions of dollars at waste in our economy from traffic. And the cost to our environment, the cost to our health, right? It's all coming off this sort of illogical way that we all choose to commute. And so there's going to be tremendous amount of value to be created here. How does that split up between the driver, the rider, partners, and ourselves? That we'll have to see as we roll out the service.
Now, as a user, I'm constantly wondering why Google Maps and Waze are not integrated. Of course, the last time you were on the show was right before the acquisition. I get into Uber and Lyft cars, and the drivers are complaining that the maps aren't integrated. Why hasn't that happened yet? Well,
since the acquisition, Waze has been kept very independent. We are actually continue to run as our own company with our own mission around traffic. And this allows us to do things like carpool, things that are bottom-up and community-based. So it's a different application, a different experience than Google Maps. We obviously share data on the back end. There are a lot of things that we share, but we have very different approaches and very different missions. For us, it's really about removing cars off the road. And 3-4 years from now, when you think about Waze, you're not going to think about Waze as the navigation app. You're going to think about Waze as the way you get to work every day.
So are you saying this will never happen? Is it on the table? Could an integration happen at some point?
Right now, that's not what we are focused on. It's not what the Geo team is focused on. We each have more than enough to do in this new changing mobility space.
So what has the benefit of the Google acquisition been?
So one of the big benefits is that we can approach something like carpool. Carpool is not going to happen overnight. This is going to take many years to change behavior. People have to change their habits, and that takes a long time. These are the kind of things you can do when you're part of Google or Alphabet, which has the resources to make these very long bets. If you were a startup and or a public company worried about your next quarter, if you didn't have the ability to think that far, you could never make such a change. And our change really brings together all different kinds of players. We've got municipalities and employers and universities, a variety of companies working together for this mission, and that's not exactly the traditional corporate environment.
Google is at the center of yet another privacy scandal, the latest one involving Google+. This time, the reporting is that the company did not disclose it, even though they knew about it. And so you have trust in the company being undermined yet again. How do you collect and use data on the users of Waze and protect that data?
So the data within Waze stays within Waze. We're very transparent with the users what we do about it. But more than that, we ask our users to share additional data with us. Our whole platform is built from users sharing their data. And so with Waze, it's very clear. You use the app, you share the data. You don't have to use the app if you don't want to share the data. But fundamentally, the data that users share is what builds the service for everyone else.
Now, companies like Uber and Lyft do background checks on their drivers. You put the decision really in the driver and passenger's hands here. How do you make sure it's safe, and what happens if there's an accident? Who's liable?
So we've designed the service to not be a commercial service. So that's, in that sense, it's very different than Uber and Lyft. You can't make money on the service. We limit the amount you drive. You can drive twice a day. We limit the amount we will pay out to you under 54 cents a mile, which is the federal per mile cost of owning a vehicle. vehicle. And so the service is designed not to create an accounting profit in terms of taxation, and to be able to work within your existing insurance as a consumer. And that's really the model that we've built, and we go to great lengths to make sure that you can't get out of that envelope, which creates that space. In terms of background checks, we provide the users a lot of information, and we do see it as up to the user to decide who do they want to drive with. We think about safety, but there are a lot of other things as well, like who do you feel comfortable riding with? One of the big features we were asked for is women feeling they want to ride with their own gender, with other women, and co-workers that want to ride only with co-workers. And so we provide all these different things. What we've seen, though, the big challenge is getting people to do their first ride. Once you do your first ride or drive, you suddenly see that fundamentally we're all pretty good people, and you discover your neighbors and your coworkers that you never knew before. And we've had phenomenal stories about people becoming lifelong friends and discovering each other through this experience.
Now, you're also doing work with the public and the private sector to encourage carpooling. Tell us about that.
So fundamentally, carpooling will have to be a joint effort. We're working with municipalities, San Diego, Orange County, all over the U.S., to try and provide incentives and carrots and sticks to users. If you think about HOV lanes, those are basically incentives for you to take another person in your car. If we can find that person in the car for you and you can use the HOV lane, you can save 20 minutes on your way to work. And these are the kinds of incentives that municipalities can do and the Departments of Transportation can provide. We think there's a place for everyone to work together here. Employers are struggling with how to get their employees to work, how to deal with parking. Parking is a huge problem for most employers. And all these different things provide incentives for carpooling. Municipalities and Departments of Transportation have budgets about removing cars off the roads. And so coming together in one platform, as we've done in the past on Waze, is the way we think we can make this change in society and in how we actually drive to work.
Our conversation there with Waze CEO Noam Bardem. Coming up, we continue our coverage of San Francisco's Blockchain Week, how one woman is paving the way for more women in crypto. Next, this is Bloomberg. We continue our coverage of San Francisco's Blockchain Week, which brings together consumers and developers in hopes of pushing the boundaries of blockchain innovation. The cryptocurrency industry is male-dominated thus far, but Sa Wang, co-founder of IOST, is pushing for progress for more women. The company is one of the top 3 cryptocurrencies by market cap, launched in 2018, and has enterprise-grade blockchain infrastructure and apparently faster speeds than Ethereum. Sa Wang joins us now. So first of all, Sa, talk to us about how IOST, you believe, fits into the broader blockchain and crypto landscape. What makes this, a good bet?
Okay, hi, thank you for having me here. Firstly, IOST is a blockchain infrastructure that we are building, we are emphasizing on POV, the point of delivery system. At the same time, we're having not only the infrastructure itself, we're building the whole ecosystem, including our own DApp team called Thesis. Also, we have our own funds called Blue Hill. We are helping with a lot of our partnerships and the communities at the same time. It's kind of like Ethereum, but a provider providing a better, user-friendly, a more developer-friendly whole ecosystem thing.
Now, it was trading around 12 cents as of February, but now it's down to closer to 1 cent. How long can you continue to operate without widespread mainstream use of blockchain technology?
Yeah, actually, this is a really good question. Right now, we all know the market is kind of bad at this time. Everyone is worrying about the price, but actually, it's kind of a great period of time for a legit project like us, because the market has washed down all of those scammy projects, all of those projects who's not really focusing on the technology and not really focusing on the social value. But projects like IOST and the other project we're really trying to build some social value will stay in the market despite of this really bad market thing. We're not worried about the price, we're not worried about those things at all. All we want to bring is some really social value project to the world.
So are any customers using your product yet? If so, how many?
Yes, we are having some partnerships right now, although our main network will be launched at the end of this year. Our maybe at the beginning of next year. But right now we have a lot of like project partnerships going on right now. There are definitely a lot of use cases right now. Like for example, last week we have a partnership with the charity company called Mantra. Like they are helping the children in Yunnan province. Like each of the sunglasses you bought from them will donate one pair of glasses to the children in Yunnan province. And definitely there's a trust gap between the community and the charity company. And then we are helping them to put all this transaction on our blockchain so that people exactly know that the money they donate to the charity will go specifically to a children in Yunnan province. So we are trying to use the blockchain technology to cover the trust gap between the charity company and the communities.
Now, the majority of people working in crypto are men. The majority of wealth held in crypto is held by men. I'm curious what it's been like for you to navigate the blockchain industry as a woman in the C-suite, and whether you think that experience will change for other women.
That's really an interesting question. Like at the beginning, it's definitely a more like a men-dominated industry because there are so many tech involved and things like that. It definitely brings us some difficulties at the first time, but it's changing to a kind of a pressure in a good way that we know women in blockchain industry should keep learning. We should keep learning not only about what's happening on the society, but also learning all the tech about the whole blockchain thing. Like with more and more talented like women coming to the blockchain world, it's definitely changing the manpower society. But that's actually a concept of blockchain. Like the concept of blockchain is to build a more equally, more social friendly environment that genders, like races, like the social status shouldn't be a factors at all.
Right. We certainly also don't want women left out of the new wealth creation either. Sao Wang, IOST co-founder and CMO, thank you so much for stopping by. Coming up, tech regulation seems more like a when than an if. So what form might new laws take? LinkedIn co-founder Reid Hoffman weighs in next. This is Bloomberg. Reid Hoffman got his start at PayPal working alongside Peter Thiel and Elon Musk. He then went on to co-found LinkedIn, became a partner at venture capital firm Greylock, and is now one of Silicon Valley's most prolific and successful investors. Hoffman bet big on Facebook early on and has always been captivated by the dynamics of social networks. Our Bloomberg anchor David Weston caught up with him earlier and asked about the certain distrust surrounding social media and what, if any, role the government should play.
It's very possible that some regulation could be good. It's a lot easier to do a lot of damage to the tech industry, to our position of the tech industry in the world, to the invention of the future, to this lead in this industry that we have, than it is to do help. So I think we should be very careful. So I think where the dialogue should be right now is not as much should we regulate, should we not regulate, as much as what should the target be? Like, for example, what do we want out of the social infrastructure of the social media companies? What do we want on the handling of data? What do we want on the new evolution of these technological platforms, AI and so forth? And what are some of the kind of guidelines that we say, look, we want you guys as companies telling us about these issues, reporting on them, and we want you to be more transparent about them so that we can see how we need to push you, and whether or not the push is a dialogue, whether the push is an inquiry, or whether the push is a regulation. And I think that's where the conversation needs to be.
So if there were constructive regulation, would it be on the subject of meaningful disclosure? Not just disclosure, but meaningful disclosure. That is to say, disclosure I can understand. Yeah. I don't have to spend 3 hours trying to sort through this thing. And then perhaps some control to say, yes, I want that, no, I don't. Why don't we have that?
So I think the question would be to figure out, well, what kind of transparency do we think would be most helpful and most meaningful to us? Like, I do think the very first thing would be is, tell us about this stuff, and if you're not being disclosive enough, then we'll make regulation to make you disclose. And then the question is, well, is it, for example, data security? Is it an ability to have controls over about your understanding how your data is being used and your buy-in to that? Those probably are the zone, but how do you do that in the right kind of simple way that also leads to a lot of ability to innovate in the future.
So as you talk with the Sheryl Sandbergs of this world, the Mark Zuckerbergs of the world, what is the discussion about how do you get in front of this instead of the appearance that you're getting dragged kicking and screaming? If we go back to the brand challenge, I think you said, how do you address that brand challenge? What could they do? What would you say to them, this is what you should do? This would get you moving in the right direction, at least.
I think the key thing is to show that you're to be transparent and disclosive about that you're investing in the things that people care about. And by the way, they are. They're investing in, like, for example, election integrity. They're investing in data security. And not just to do it, but to show people you're doing it. To show people you say, I hear what your worries are, and we're working on them. And by the way, it may take us a few iterations to learn it exactly, but we care about it, and we're investing in it. And then to be talking about that. And I think they're beginning, I think they're on path to exactly those conversations.
LinkedIn co-founder Reid Hoffman there with Bloomberg's David Weston. You can catch their full interview on the next episode of Bloomberg Big Decisions, November 7th. And that does it for this edition of Bloomberg Technology. Tomorrow on the show, do not miss our exclusive interview with Microsoft CEO Satya Nadella. I'm Emily Chang, coming to you from LA today. This is Bloomberg.